So today is a bloody day out there as both the stock market and crypto are crashing across the board. Most of this is driven by an event we already know, and it is the unwind of the Japanese yen with its carry trade against the US dollar and foreign equities. So as the Bank of Japan is raising interest rates to above 0% for the first time since 2008, this is causing them to unwind all of their positions that they were able to take on very cheap, essentially cheap leverage that they have to unwind. So today I will explain the reason why this rate hike from the Japanese central bank is causing this sell-off across the globe, and more importantly, we'll dissect how this relates to the US Fed's interest rate cuts potentially coming earlier than the next FOMC meeting in September. And this all ties together into the fears of recession. So there's a lot of things to unpack here, but just bear with me. We'll go over all of them today. And in the end, I will also cover my strategy for the next 45 days, as this is the most crucial time in the markets leading up to the next FOMC meeting. Okay. Welcome everyone to the VirtualBacon channel. If you're new here, my name is Dennis. I'm a crypto angel investor for the past 6 years, and I have invested in over 100 crypto startups. On this channel, I share views on market trends and investing strategy to build wealth in crypto. Okay, so let's get right into this with explaining what the Japanese yen carry trade is and how it is being unwound right now. So first of all, I want to give a big shout out to Ran and his team at Crypto Banter. I have been following his coverage on the situation for the past week, and I have to say he has gotten it spot on. So if you just go watch his live streams for the past week, there was a very definitive time when he turned around on the market and realized that there is this situation happening in Japan where last week the Bank of Japan raised interest rates from 0% to 0.25%, and this exactly coincided with the sell-off not only in crypto but also in US equities. So just go ahead and watch this coverage on this whole topic very in depth. And this was 5 days ago. This was before a lot of these even happened, and I believe this was right around the time when Warren Buffett started to sell all of his positions. So big props to them. And let's just look at the market really quick today. So across the equities markets, we don't usually look at these very often, but now the crypto sell-off today is directly driven by the same reasons behind the equity sell-off. That's why we have to look at all the markets across the globe. And you see right here, the S&P is down across the board, all red. And of course, in crypto as well, Bitcoin, Ethereum, BNB, Solana, whatever you have, all down double-digit percentages across the board. So all of this stems from the Japanese yen unwind. So what is happening here? So basically, the Japanese central bank, the BOJ, has raised interest rates on July 31st, 7 days ago, to 0.25% from 0 to 0.1% after a vote. So very important is that this is unlike a rate hike in the US, because in the US, there has always been adjustments in the interest rates. Sometimes it's high, sometimes it's low, but it's never really zero. However, in Japan, their interest rates has been kept at zero since 2008. So you see here, ever since 2008, this yellow line here is effectively kept at zero. Sometimes it's even a negative. So this is very different from the rate hikes in the US Fed, because when you have a 0% interest rate, effectively this means borrowing money is free. So this has led to a lot of borrowing from the Bank of Japan, the Central Bank of Japan, and those money is literally free. You don't have to pay interest, and you can use them to invest in any other type of assets. Now, this is why even a very small policy change here from 0% to 0.25% is a huge deal. Because when you have free borrowing from a central bank, effectively what they do is, well, you can take on as much leverage as you want, as much as they allow them to. And you can use all that free money indefinitely to invest in whatever type of assets. Even if you go for a super safe asset, however low the percentage is for yield, that is free yield for free loans that you get from people. In this case, from the Bank of Japan. Now, what's interesting here is this article here from Zero Hedge is the most in-depth breakdown of this that I have seen. And I'll leave this in the description after the live stream. You guys should definitely go read this. But they have basically summarized that the size of this carry trade is as large as $20 trillion. And that's not to say all $20 trillion will be liquidated or have to be unwound, but this is specifically looking at the Japanese government, not even any other entity. So take a look at this here, just to summarize. This is a figure of the Japanese government's balance sheet consolidated, and with a percentage comparison with its GDP. So you see here, on the liabilities, the Japanese government, this is how they're funded, right? When you have liability, this is how you take money in. So the Japanese government is primarily funded in low-yielding Japanese government bonds and even lower cost bank reserves. So effectively, over the last 10 years, the Japanese government has effectively borrowed against all of its banks at 0 to 0.1% interest rate. So it has basically just printed cash and given to itself at 0 interest rate. And then on the asset side, the Japanese government mostly owns loans, for example, via the Fiscal and Investment Loan Fund, and foreign assets, primarily via Japan's largest pension fund. So when the Japanese government gets free cash from its central banks at 0% interest rate, they have loaned them out, effectively given people and taken the interest rate that they give them, pay them for the loans. And then they also use these to invest in foreign securities. So this is what they mean by the big carry trade. So how does the Japanese government make money with its balance sheet? It tells the central bank to print money, give it to themselves, loan to themselves at 0% interest rate, and then it then loans that money to other people at slightly higher interest rate, which gives them a profit in the carry. This is what a carry trade means. And also it invests in foreign securities, most notably, of course, the US equities, S&P, NASDAQ, whatever top tech stocks in the US. So this is why they call this the giant carry trade from Japan, because effectively this is what they do. Even if you have very low investment skills and low investment potential, when you have such large amount of cash at no interest rate, you just basically take on very safe investments and you have free returns. Now, the downside of this is that because they have gone so long at its 0% interest rate, now that the Japanese economy isn't doing so well, and now that they are actually facing high inflation on the Japanese yen, which we can see right here with the Japanese yen against the US dollar. You see, since basically for the past year, so Japanese yen against the US dollar has been trending very, very down. So it's getting inflated away. So the Japanese government has no choice but to increase rates from 0% to anything positive, 0.25%. So once they have done this, they have started to dig themselves in a hole, because now the money that they borrow from their own banks is not free. So they have to actually make good investment decisions in order to not lose money. So this is why this trade is starting to be unwound with the Japanese government. And this is why these things that they have loaned out to other people and by themselves as well, investing in foreign securities in the US, now have to be sold in order for them to pay back their liabilities. So this is basically summary of the Japanese unwound trade and how it's causing market crashes across the globe. We have seen already in Taiwan, in Korea, both markets have seen large drawdowns today. So, and of course, we have seen the Nikkei being down over 12% on the daily today. So this is actually the largest daily drop on the Nikkei index ever. This is what I've heard. So don't quote me on that. And of course, you also see, for example, the NASDAQ and the S&P. So here we have the S&P being down 4% from Friday's close. And we have the NASDAQ being down 5% from Friday's close. But you see the S&P and NASDAQ is already starting to bounce a bit. So this is looking pretty decent, to be fair. Not as bad as people put it. So then the question is this something to be concerned? And will this actually impact the rate cuts and rate hike policy from the US Federal Reserve? So then we get into the second most talked about topic right now, which is an emergency rate cut from the Fed. So if you just Google rate cut right now, you see a lot of these people talking about the Federal Reserve of the US having an emergency rate cut before the next FOMC meeting. Now, a quick refresher here. The next FOMC meeting from the US Feds is on September 17th. So basically, everyone has already priced in across all the analysts. We already know that in September, there will be a rate cut from the US Fed. And they even have said this themselves in the last meeting in July. So now the only question is, does the US Fed need to step in order to stop this market drawdown today? There's a couple reasons why this might not happen. So first of all, the Federal Reserve has only stepped in a couple times as an emergency before a planned meeting to cut rates and introduce other emergency measures. So the only last two times that they have done this, the closest time that we have is in March 2020, right after the pandemic was brought up and officially confirmed. And then the time before that was in 2008, right after the Lehman Brothers. So the fact that today a lot of people are calling for this, even though nothing has broken in the US financial system, is showing a first sign that the US Federal Reserve might not actually do this. Not immediately, they will tend to wait. Now, some people will say, okay, why don't we do this right now? If we start cutting rates right now, markets can just rally, right? That's not so clear-cut as you might seem. So I want to bring you guys up to the second piece, also from Zero Hedge, that I found to be really insightful. So market carnage sparks emergency Fed rate cut hope. A lot of people are hoping for this, but this might not be what you want. So basically, what we really want at the end of the day is for asset prices to go up as investors. However, in order for that to happen, just cutting rates indefinitely might not be the most ideal case, because you also want to avoid a recession at the same time. So a lot of people throw this idea of recession around throughout 2022, 2023. I didn't really understand it until I really dug into this as well. So don't call me as an expert here, but this is just my understanding. So when you have a tightening cycle, and right after a tightening cycle, in order to stick the landing, you need to avoid a recession, or some people also call it hard landing. So in order to avoid a hard landing and go into a soft landing, what you need to balance is the recovery in the hard data, or in this case, the inflation data and employment data. And you need to balance that with the recovery of asset prices, or the soft data, such as the S&P, stocks, index, commodities, real estate, risk assets, crypto, etc. So you need to have both of these things recover, and you need to not make them correlated with each other on the downturn. So this is effectively what the biggest risk of a recession is. So when reflexivity rears its head, positioning creates its own reality. So this means when market participants, they don't really understand how the economy data work and how market data work as much. And in usual times outside of a recession, even if a unemployment is bad or the inflation is bad, that doesn't necessarily contribute to a drawdown in asset prices. We have seen this time and time again. Even right after the pandemic, market was rallying while everyone was in lockdown, right? So that was actually an okay scenario because at least that wasn't a recession. Something was going well. However, if the Fed comes out now and confirms that with emergency rate cut and says, okay, like our employment numbers and our inflation numbers are also not doing well, and thus we need to have this early rate cut, then that effectively confirms the correlation between asset prices and hard data, the CPI and the employment data. So once that happens, the fear of recession is at its highest. So this is what really, what I understood after reading a lot about this. So let me show you this chart right here. Yeah, so this is the correlation of soft data and hard data, and when asset prices had the worst drawdowns. So you see, even if asset prices are going down, as long as people don't have this belief that we are in a recession and that everything is going wrong, the price crashes usually don't lead to that bad, and they don't last that long. However, when you have both the soft data, which is the asset prices, and the hard data, which is CPI and unemployment numbers, both being stressed, then you have serious drawdowns. So you see the two times that it has happened, 2008, and then last time before that, this is like 2002, this is like 1998. So this is where we are at today, which is that asset prices have been doing okay this year, while the hard data, the CPI and the employment data hasn't been doing that well. So the Fed now has to really balance the two and not confirm with essentially the economy and say that our hard data is also doing bad while asset prices are crashing this week. So let me just read their summary here. The stressed soft data can then, recessions are regime shifts. So shifting from people's belief that the two are uncorrelated, going into a recession, then people will start to believe that the two are heavily correlated and can go down together. So once the recession is widely kind of confirmed by the retail audience, the regime shifts, and then this can cause a feedback loop between the real economy or the hard data and the market, which is soft data. So when the hard data starts to become excessively stressed, so people getting unemployed and inflation numbers being high, it can feed negatively into market prices and into other soft data, such as the surveys. And then once the feedback loop actually cements itself, this stressed soft data or the prices going down can then start to negatively impact the hard data. So in other words, the falling stock prices and wider credit spreads hit the wealth effect and constrain capital markets, and then basically the economy also gets hurt from asset prices going down. So this is a scenario we want to avoid, and this is what essentially a recession, why it's ultimately dangerous. And okay, a lot to unpack there, but TLDR, even though a lot of people want the Fed to cut rates as an emergency this month, it likely will benefit us more if they wait until September, because the two roles of the Federal Reserve right here. The Fed has two mandates: price stability and full employment. And it also has a third one, financial stability, which is only noticed when it is missing. The bar right now is too high for an emergency rate cut. If they have done such a thing without some sort of stability issue at hand, such as banking collapse like the Lehman Brothers or literally a global pandemic crisis, so even when the US stocks slide in prices, we are still higher on the year. And an emergency rate cut aimed at calming the market could cause more panic considering the Fed's need to restore market confidence. So there is a summary here that he didn't say, which is that if the Fed chooses to have an emergency rate cut right now, people will not believe that they're doing this for the sake of, just calming the market, because the Fed literally has to say that either inflation is out of control, or unemployment is out of control, or the market, something in the financial system has broken in order for them to do this. What are they going to say? Right now, nothing has been broken in the banking system. There's no pandemic going on anymore. So if they come out and do an emergency rate cut, they can't just say, oh, we're going to prop up asset prices in the US because the S&P is down too much. They can't say that. They have to say, we didn't do our job well. Inflation is out of control. People are getting unemployed. So if they come out and say this, people's reception of that will be really bad, because this effectively confirms that asset prices going down, and it becomes an indicator that shows that inflation is out of control and employment numbers are bad. And then the two can become a negative feedback loop, and that is what causes a long-term recession. So this is why, even though a lot of people are saying that they want a emergency rate cut, some of the experts are actually coming out and saying that we don't want it right now. Okay. Now, how will the market react over the next 45 days? Remember, the next official FOMC meeting is September 17th and 18th. So we know that from the CME FedWatch tool probabilities, we know that we will for sure have a rate cut, at least 4 rate cuts that have been priced in at high probability by the end of the year. So take a look at this here. The September meeting, 89% chance we're going to have a 25 basis points rate cut. And then right after that, in the November meeting, once the cycle starts, less than half the people believe we'll have another 25 basis point rate cut. And actually more than 50% of people believe that it will be a double cut at 50 basis points. And then again, by the end of the year in December, people have even higher probability, 78% probability that people are pricing in a total of 100 basis points, or a whole 1% rate cuts by the end of the year. 78% of the people or analysts believe that. So this is basically already priced in. Not priced in. This is basically already confirmed, which means by September 17th, 18th, end of September, asset prices should do much better than right now. And by the end of the year, they likely will continue to do well. So this downturn for the next 45 days is going to be short term. It's not going to last that long. But the only question is, on a lot of people's minds now, is will the asset prices crash further across stock market, across crypto? And that is actually not 100% guaranteed, because there are 2 ways that this can go. So if the situation is under control, we can monitor this with the S&P, the NASDAQ, but more importantly, the VIX, or the volatility index of the S&P. So historically, the volatility index directly has inverse correlation with all markets. And this is the main thing we need to monitor, because as long as the WIX doesn't have a sustained high volatility here, asset prices will be under control. So if we zoom out on the WIX here, so a lot of people this morning have noted that the VIX has peaked as high as, let's see here, 64, the volatility. And the last 2 times that it has peaked this high was right here, March 16th, 2020. This was right after the pandemic was confirmed. And also in October 2008. So right after the housing bubble. So people have already started to draw a comparison between today to the pandemic and 2008. However, a big difference here is that we are only half a day into this candle here. So if over the next week, the wicks can sustain itself and not go up much higher, then this is going to look much more like any of these smaller volatility peaks throughout many times in history, right? Many times. And this wouldn't be that bad of a period. However, if over the next week, we have a sustained, I wouldn't say rally, sustained increase in the volatility. And what I am actually watching here is this right here. So if I actually hide the main daily candles and take a 5-day moving average of the wicks, you see this is much clearer. So if we can get the 5-day average volatility over, let's say 40, so basically reaching the third historical high, like this, if this average number can go up so high, then this most likely will cause something else to break in the financial system, whether that's banking collapse, whether that's whatever it may be. And if that happens, then the Fed does have a reason to step in, because then it's no longer about unemployment, it's no longer about inflation. They could use that reason to step in if something actually breaks, if the volatility can maintain this high for a week. And if they do it then the problem wouldn't be as bad. Then it's much more believable, whatever they announce. Instead of people, looking at their emergency rate cut as a confirmation of recession, they will look at the emergency rate cut like actually they need to step in because something broke, like during 2008 and like during the pandemic. So this is why this is still a scenario on the cards. And the question is here, if we get sustained volatility over the next week, asset prices are still going to drop further. Now, is this confirmed to happen? No, nobody really knows at this point. Just like, if you're trying to predict some banking collapse, nobody's going to know. But you have to be prepared in case this happens. So this is situation number one. If the situation gets worse and more volatility on the wicks comes and something actually breaks in the financial system and emergency rate cut does happen. But it wouldn't happen right away. We're going to have to wait probably at least a week. Now, on the other hand, if we don't have more volatility over the next week and the moving average of the wicks stay at current levels, then it's highly likely that the Fed will not step in with any emergency rate cuts. And we will likely only see choppy asset prices for the next month, leading up to September 17th, the next FOMC meeting, when finally rate cuts cycle starts and then asset prices can rally again. So if that happens, then what about the current prices in the markets? Well, they are already quite cheap because today there was a huge panic across the board. So if we don't get any more volatility and something drastic happening, chances are this is going to be a good buying opportunity. So that is on the other hand, if the situation is already under control. So when you look at the two scenarios together, some people will say, oh yeah, you're just saying like it could crash further or it might stay at current level. Yes, exactly. Because the only way that this crashes further is if something seriously wrong happens. And it is a possibility at this point. So you have to be prepared. Okay, now, during times of these uncertainty, what's most important? One other takeaway that I've gotten from this article from Zero Hedge is that the most important action for investors is not to predict whether something will break and we're going to go much lower in the immediate short term, or if it's just going to chop. Instead, you need to take a probabilistic approach and position yourself directly. So what do I mean by that? Number one, you don't want to take on any leverage right now, because if something triggers, something seriously wrong happens, we could drop another 20, 30%. Easy. Even on Bitcoin, Ethereum, etc. And you have to be okay with that. So as long as you're okay with that, then with that assumption, current prices is already a really good buying range, really good buying levels. So that's basically what I'm doing. Let's get into my actual strategy here, and let's actually look at some price levels here. So here is Bitcoin. Let me bring the charts up again. So you see here, we are 43 days away from September 17th, the next FOMC meeting. If nothing wrong happens from this point, everything is already priced in from the Japanese yen unwind trade. Then if we just get chop in 50K to 55K, whatever, right? You're not going to get better prices since beginning of the year. And that's okay. Now, if we do drop further, two levels to look at. There is a bit of consolidation right at 41K to 43K. You see here, this was between December 4th to January 30th of late last year. And then a bit of touches here for Confluence as well, going back to October 2021 and then March 2022. So this is the first area of significant support that I really hope we don't break. So if we get a further downside here, but if even this level breaks, then we're going to be looking at something like the bear market resistance levels now turn into support at 30K. Am I saying 30K is on the cards? I don't know. I really hope it's not, but I see some people already calling for 30K. I think that's not outside of the realm of probability if something crazy happens. Like the first scenario that we talked about, if a bank actually collapses, all cards are on the table. But if that doesn't happen, I don't see us getting below 42K. That's what I'm looking at. So my strategy on Bitcoin, already starting to buy with the little amount of powder that I have left, will continue to buy as long as, fingers crossed, nothing breaks in the US financial system. Similarly on Ethereum, already starting to buy, and actually we have touched the bear market resistance levels, now turned to support already. These levels right at $2,000. So you see touches back here, here, and here. And just this morning, we have already wicked into this range at 2,000 and bounced a little bit already to 24 now. So I am already also starting to deploy into Ethereum. Again, we're talking about buying Ethereum at $2,000 to $2,400 when we were trading at, what is this, like 3,500 2 weeks ago. Like, what more can I say here? Like, if you want much lower, if you have to bid much lower, go ahead. But I don't think you're going to get better chances. So again, with our time on our side here, actually, until September 17th, how much further can this drop? As long as you're not taking on leverage, what more could you lose here? Sure, you could wick through these levels and maintain there for 45 days. But I think we can all agree that by the end of the year, rate cut cycles, after 4 rate cuts happen, after 1% rate cut total, are we going to get these asset prices again? I don't think so. Most likely we're going to be much higher than we are at right now, even in late September, and for sure by the end of the year. So that's Ethereum. And then also, very no-brainer bet right now is Solana. So levels on Solana are actually a lot clearer because clearly Solana is the most, actually the strongest asset in crypto in terms of large caps. So you see here, actually Solana is still respecting its support ranges. So here is the weekly chart here. So you see a lot of consolidation between $80 to $115. which dates to back here, here, and then up here, down here, up here, a little bit of resistance before the breakout. So you see on the panic liquidation today, already touched that 110 level. So again, I'm already starting to dollar cost average into Solana, and will continue to do so as long as we are kind of in this range right around $100. And again, fingers crossed, as long as nothing dramatic like the pandemic crash or the 2008 crash happens, I don't see us getting much below $80. So yeah, that's just how I'm seeing it right now. You might disagree, but I doubt we're going to get much better entries at current levels. And that's basically it. So I don't want to cover too much high risk altcoins here. I don't think you need to take those bets right now, because the easiest assets right now, also think about how crypto cycles work, right? Remember that the money flow in crypto, once the cycle rinses itself back, going from low caps, all the money will flow back into cash. And then once they come in again, they will start from the top, Bitcoin, Ethereum, Solana. Very simple. Even if you're bullish on gaming, AI, meme coins, whatever, doesn't really matter. You have to start from these high levels. In order for those assets to have a strong recovery, we have to see bounces across the board on Bitcoin, Ethereum, Solana. So just keep it simple, especially if you're following these macro trends. You know, the biggest assets in crypto are going to correlate the most. Daily Shorts says, let the recession begin. I'm sick of all this manipulation and games the 1% are doing. So, okay, there's a big difference here. The recession is best felt as a short-term crash instead of a sustained long-term downturn in both the economy and asset prices. So what he says here is, with rate cuts now guaranteed, the best outcome ironically is the worst one for markets in the near term until the rate cuts start, which is some sort of a crash or a credit event, because this will lead to central bank panic based on something going wrong in the financial system, and they can actually inject much more powerful liquidity response and form essentially a V-shaped recovery instead of going in slowly and then people continuing to feel the pain through a prolonged recession. So the two times that we have had a significant crash that caused the Fed to actually step in and start to cut more aggressively was in 1987 and 1998. So after both of these events, what happened to the S&P prices 3 months and 6 months after? So 3 months, the S&P was up 14.6% average, and 6 months after, up 19.8% average. However, all other times, especially with a hard landing with so-called recession, we have seen a prolonged, basically bear market. You see here in 73, in 80, 81, 90 to 91, 2001, and then 07 to 09. And throughout all of these, even though there was a rate cut, the 3 to 6 months right after the rate cut, there was still a negative performance on the S&P. On average, negative 6% 3 months after, and negative 3% 6 months after. So it took some time before the market actually picked up again. So this is why we actually don't want a recession. So people think like, oh, the Fed is going to announce a recession, and all of a sudden everything is going to crash and then everything bounces back. That's not what happens. A recession is a slow bleed, and that's what we want to avoid. So either something breaks and the Fed steps in and it becomes kind of a pandemic V-shaped recovery scenario, or they take it slow and have a soft landing. So this is why they cannot have a emergency pivot, emergency rate cut right now, because that will essentially put us in the second category here of a hard landing. If we continue to wait and starting September, chances are we have a chance of a soft landing, like these scenarios on the top here. And we could still see a quicker bounce back on the S&P 3 to 6 months after. Or if this crash gets much worse and the Fed has a good enough excuse to step in early, then we can also have a good scenario to asset prices after, like this third category of a crash. So this is why, people are tired of this word recession, but the reason why that Fed always says, and they always pander so much about like, we hear you guys of this fear of recession, but we're actually not in it, is because they need to make it unclear. They need to discorrelate people's expectation of asset prices and inflation and employment numbers. As long as the two are uncorrelated, we don't have a prolonged bleed. But once the two are correlated, it becomes a negative feedback loop, and that's what we need to avoid. Sumo asks, should I buy low cap now or wait? So my stance on this, I will try to cover in another live stream about altcoins specifically, but I don't think you should be focusing on low caps right now, because the liquidity in crypto starts from large caps, Bitcoin, Ethereum, Solana, into like large altcoins, into mid caps, into low caps. So whatever recovers first is going to be the most liquid ones and the largest caps. So especially now, after this reshuffle in the market, it's no longer about which coins do you buy that can outperform other coins. It's more about when do you buy the coins, and do you have good strategy to position yourself in the strongest coins so that when liquidity flows back in again, you are positioned. So that is why I myself am actually focusing on large caps right now, not low caps. So I use this chance to sell a lot of my low caps. I talked about this in my Telegram and Discord as well. So I sold a lot of low caps and consolidated positions into Bitcoin, Ethereum, Solana, and some large cap alts, but basically have no exposure to anything below 100 million right now. I think those will, it's very hard for those to outperform Solana, like on the Solana bounce, because Solana itself is already down so much. Like, why would you buy a meme coin on Solana right now? Doesn't make much sense. If you have more questions, make sure to join our Discord, and link in the description, discord.gg/virtualbacon. And another thing you should follow me on is Twitter or X at VirtualBacon0x. This is where I drop all the quick alpha before I do them as live streams and in-depth videos. The Fed will have 4 to 6 rate cuts by the end of this year. The money printer will be turned back on. So whether they turn it back on slowly, if we just continue to chop and we try to stick a soft landing, or more aggressively, if something breaks over the next week, we see even higher volatility and they have to step in with an emergency, doesn't matter, because by end of September, the rate cuts will start. And by the end of the year, we will have at least 4 to 6 rate cuts, and asset prices will rally higher than current levels. So do not lose hope. There's no point in selling right now. Hang in there, just control your leverage. Don't get washed out in the next 45 days, and there are much better times ahead. That's it. That's the best advice that I can give you guys. So thank you guys for joining, and make sure to follow me again on Twitter and Discord, join our community. And if you like this video, share it with a friend, subscribe to the channel, and I will see you on the next video and next live